long-term return.
We have to talk about Silicon Valley Bank. It's been developing toward the end of the week. A lot happened. They pretty quickly went into receivership from the FDIC. What does it tell us more broadly about what's going on in the banking sector or in the economy?
Look, there's still plenty of fog of war here, and we're still all trying to sort through it. There clearly was a big managerial failure. It sure looks like regulators were not on the case in the way they could have been. Right now, it looks like this is not a broad systemic issue that Silicon Valley Bank and perhaps several other banks, but not many other banks and none of the largest banks had a mismatch between the kind of deposits they had and the ways in which they had invested their money in longer-term bonds. And so I don't think this is likely to be a broadly systemic problem. But it certainly is going to have very substantial consequences for Silicon Valley, for the economy of the whole venture sector, which has been dynamic, unless the government is able to assure that this situation is worked through. Right now, the holders of uninsured deposits have been told that those deposits are frozen and can't be withdrawn. There are dozens, if not hundreds, of startups that were planning to use that cash to meet their payroll next week. If that's not able to happen, the consequences really will be quite severe for our innovation system. I suspect that ways will be found to at least provide significant advances on those deposits to enable the payment of payrolls. I think the FDIC is going to have to think very hard about how to be maximally creative in using its authorities to assure that this doesn't have a set of collateral consequences for the innovation economy. I don't think this is a time for moral hazard lectures or for talk about teaching people lessons. We have enough strains and challenges in the economy without adding the collateral consequences of a breakdown in an important sector of the economy. So I hope that they will, in the short run, be aggressive about containing the problem and containing possible contagion. And then over the medium term, I think there are important lessons for how we regulate, what roles we use for market values in regulation that need to be learned from this experience. I think we have tended to have a bit of a romance with the community bank relative to the larger banks, and we're going to have to figure out how to maintain banking services for communities while moving to also pay attention to making sure that we've got as much financial stability as we possibly can.
Whenever we talk about financial stability, we are reassured that the banking system is so much stronger than it was before 2008, 2009, so many reforms. Is there some question now about whether that's exactly right? And let me be very specific. What about the stress tests? Why didn't they kick this out?
Look, I think I have written that there are a lot of concerns about the stress tests. I do not believe the stress tests give an accurate picture of the resilience of the banking system. I think they are far too optimistic in thinking about what would happen in a catastrophic kind of scenario. That said, I think any fair-minded observer has to think that banks are better protected than they were before the 2008 financial crisis. though I think we have to recognize that a large part of the lending in the country and lending to businesses is now done by institutions that are not banks. And so there are important issues in the shadow banking system. So this certainly should come as a reminder that rational financial regulation is hugely important to the success of the American economy.
Larry, we also got jobs numbers out on Friday this week, and they were more robust once again than expected, 311,000 new jobs. At the same time, the rate of wage increase actually came down just a little bit. What did those tell you about the strength of the economy and, for that matter, where we're headed with inflation?
I think that most of us probably have a kind of now more than ever view after these numbers. If you were a person who is very worried about inflation, you focus on the strength in the economy and the seemingly ever tighter labor market. If you're a person who is less concerned about inflation, you probably take heart from the lower wage inflation number. So I doubt these numbers changed too many minds. I'm going to be watching for the CPI number next week, but I think more broadly, it seems to me that we don't have a lot of evidence of a basic downwards trend in inflation. It looks to me more like the inflation story is fluctuation around an underlying inflation rate of 4.5 or 5. And if that's close to right, it suggests that the Fed has considerably more work to do.
Well, that's exactly my question. What does it mean for monetary policy? What do you think the Fed should take away from these numbers, and what does that mean they should do? For example, on terminal rate.
I suspect that there's a quite good chance that we're going to need to get to a terminal rate near 6. After all, we have inflation running at close to 5%, and we have interest rates at about 5%. And so interest rates and inflation in the same range doesn't point to a lot of pressure to bring inflation down. So I'm very much open to changing my mind, and I think confident pronouncements about these things are a mistake. If we get a strong CPI number on Tuesday, I think the right thing to do will quite likely be to increase rates by 50 basis points in March, because if we're pretty confident that rate increases of that magnitude are necessary, I don't see much reason not to get on with it. If the CPI number is more moderate, then I think it's or comes in surprisingly low, then I think it's a very different kind of judgment that needs to be reached.
Right.
In general, I think there is more risk of underreacting to the inflation concern than of overreacting.
Larry, finally, and briefly if we can, what about the budget that we saw out of the White House this week? $6.9 trillion, spending an awful lot more on a lot of things. Are we having a serious discussion about the federal budget on either the Democrats or the Republican side at this point? And if not, how do we get to one?
There are a lot of good ideas in the budget, but I think for a variety of reasons, the deficit path is likely to end up greater than the administration imagines unless there are substantial policy actions. And I think we're getting back into a phase as interest rates rise where it's going to be very important to think about the long-run behavior of budget deficits. In many ways, the picture is more adverse than it was a decade ago when the Simpson-Bowles process was launched. So I do think we need to have that as a bipartisan conversation. I welcome the president's providing his budgetary blueprint and asking the Republicans to provide their political blueprint as a basis for conversation and dialogue. I am glad to see rising focus on containing healthcare costs because that's probably the single most important issue in thinking about the budget over the longer term.
Right.
Though I'd have to say that my judgment is that the ultimately necessary expenditures on national security are going to be substantially greater than in the president's budget.